understanding alts, the asset classes, and the tax structures.
Yeah.
To do well by your clients. That's the kind of thinking you need to start doing. Welcome to the Land and Everything Else and FinTape podcast. If you're listening in, it's going to be a little bit different. Land and Everything Else. We're going to have Brodrick at the helm, a very good friend of mine, and the founder, owner of Pod Pony. And so we're going to run this one on Land and Everything Else as well as FinTape. And we all got together, both co-hosts in the same podcast.
I know, this never happened.
I think this happened once when we started.
It is. Yeah, it's been over a year ago.
And now here we are, just dozens of episodes later. But we're so excited for this joint episode, and I'm thrilled you're here.
Talking about alternative investments. This is the second FinTape podcast where I'm joined by Dr. Craig Lemoine and Ailie Elmore. Really excited today. We're at the Land Investment Expo here in Des Moines, Iowa. Not many things are going to get me to get out of my house in January, but this event has done it twice.
Yes, it has.
This year there is no blizzard. We're much safer, except I did stay at the hotel that has a skywalk.
Yeah.
Did y'all make the same decision this year?
I have PTSD around the skywalk, and that's why I stay in the conference hotel now. And I'll just say that.
Yeah. No, last year I made the mistake. Last year when we were here, it was your first time here.
Yep.
When we had the foot of snow. And I made the mistake of not staying at a hotel connected to the skywalk.
Oh, no.
And I was trudging through the snow, like trying to walk. And it was only 2 blocks from here.
Yeah.
And it felt like I was trudging like across the world because it was blizzarding. And I I'm wearing the nice shoes and all the things. And yeah, it was just not fun.
Yeah,
but
back then, my father-in-law joined me, as you remember, Barry.
Yes.
And we came in with these big Pelicans. He's like, this is kind of tough. These big bags for all the podcast equipment. He's like, you need some help, and found our very own Pete, our producer, who's sitting in the background, always listening, never says anything on these, but he knows everything we say, so watch it. On that note, let's talk about some volatile things on this podcast today. What are some trends around alts?
I'm going to jump in on there and say you often have non-volatile things, right? The trend that I've seen post-COVID and the investment advisor space is you've seen technology and AI tools advance at rapid rates. They started to do some of the things that advisors used to do. And what that's cleared up is this huge conversation in the investment space and around, I've heard it phrased everything from adding alpha to earning your fee to like the basic idea is I used to charge 1% assets under management when I did a lot of the technical myself, and now I'm not doing that. So then what am I doing such that 1% is earned? And I think you're starting to see an answer to that being, well, I'm able to provide my retail client with alternatives that in the past were only available at the institutional level, right? That seems to be, in my opinion, the biggest post-COVID trend, that and AI in wealth management. Those are alts and AI. Those are the two hand-in-hand post-COVID trends.
Yeah.
And so I jump on that because the word volatility, because one of the things is I've explored alts in the land space and my study and scholarship is, that's the negative volatility, right? That's the idea of a smoother portfolio. And that's where I think we need to be pretty specific, but I'll jump in that later.
Yeah, I think that you've summed it up really nicely, especially as we look backward looking, as we look more forward looking, like what we're going to see potentially in this next year, especially when we're recording this now, we're a week out from a new administration coming in, and they have some pretty volatile plans, I guess we could say, that might affect alts. Trump has come out and endorsed cryptocurrencies in particular. And so I think that's really interesting. You've seen a lot of movement in the space whenever he makes a tweet or a comment about it. I think you're going to see some interesting trends in the land space, not even just because of the Trump administration, but also because I've seen, we've got more and more companies coming out with the return to work, like you've got to come back in the into the office 5 days. And so you're seeing boosts in commercial real estate. I heard a stat yesterday that 20% of office buildings in major cities are still unoccupied post-COVID. And you've seen a lot of these companies and firms instituting those policies, whether they say it's for productivity reasons, but there's questions around, okay, well, is it just because we have this lease that we need to put, bodies in the seats? So I think it's going to be a really interesting year. We've, obviously got potential inflation pressure still looming. We're not quite sure what the Fed is going to do in this next year, and that obviously has a huge impact on the leverage of an alternative investment. And so it's interesting. I'm skeptical in a lot of different realms, but I'm always bullish on alts.
Yeah, well, alts, it's a vast space.
It is.
So it's hard for a lot of people to wrap their heads around, including myself. So not above anybody who's listening to this show today. But as a result, a lot of financial advisors, well, they don't, if that comes up in conversation, a lot of people steer away from it. And I actually just interviewed someone not too long ago who said, why on earth would you want to tie up any of your wealth in something so illiquid?
Mm-hmm.
And why at most, if it's anything more than a hobby, it's just stupid.
Well,
stupid all around.
I would argue that a lot of alternatives are going to have liquidity premiums, which is a fancy way of saying you're not going to touch your money, and in turn, you're going to earn more than you would have had it been able to be touched, right? Easy to example being a CD, certificate of deposit. 3-month CD is going to yield, but nowadays probably 1.25, and then maybe you have a 3-year CD yielding 3, right? You get more money if you lock the money up. Mm-hmm. And I think with alternatives, that a liquidity premium is a struggle for investment advisors. I think it's a struggle twofold. One of them is that we need to make sure that there isn't a liquidity premium, right? If I'm having you lock up your money, but you're going to have the same risk return profile as a liquid asset, then there's really no value to locking up your money, right? There's that liquidity premium isn't paying. I think the second end of it too is that we struggle right now with compensation models in the space. We continue to struggle with compensation models. If it is on a custodial platform, you can wrap a fee around it, and it's so easy, right? As far as an investment advisory goes, if it's on Schwab, Fidelity, BNY, whatever platforms there are, and I can put it in a client portfolio, I can charge them 1%, and my world is uninterrupted. On the other hand, if I have to pull $500,000 out and I utilize a service like AcreTrader, now that $500,000, I'm not getting paid on it, but I gave advice on it, and so I probably should get paid on it because I took the risk of giving the advice.
Yeah.
Yep.
But now I need a different comp model. It gets more complicated. I have 2 thoughts about liquidity and illiquidity, right? But I think you're right. If there is no liquidity premium, I struggle with that, right? It's like, private credit struggles with that. Is like, okay, private credit, can I get a slightly better spread? Is that spread worth the lockup? And that is a challenge.
Well, yeah, you're hitting it right nail on the head, especially when we move on to that credit comment that you're making. A lot of your more traditional forms of credit and capital are very leery about some of these models and some of these opportunities from the standpoint of some of them haven't been around very long. And so most of your lenders post 2008 financial crisis have really hammered down on their credit standards, their investing standards, and things like that. And so you've got an interesting landscape of, you've got some institutional capital that is very excited about alternative investments, especially on the large scale space. And then you've got your debt providers that are a little bit more leery of the space. And I think that because of the liquidity premium aspect of it, that's a concern. And so, yeah, I think those are some of the mindsets when it comes to, and the other aspect of it is we use alts as the blanket term, but it really requires, it's just this blanket term of all of these incredible things that aren't stocks and bonds. Right. And so you really need specialized knowledge and education in the space in which that you are going to be working, and trying to find those right partners that can educate you on different fee structures and fund structures and things like that on this, and just on the asset class itself.
But I'll flip liquidity then to where it does make sense, right? When we talk about farmland, right, there's an acquisition then the land is productive, and then there's a disposition, right? All these things take time. So if we're going to pool assets, Ailie and I pool assets, and we both put $1 million in, we buy a $2 million piece of property. We buy the property. There might be upgrades or invest in the land, the irrigation, whatever it is that we're going to do. Then that property goes into service and we farm the property, or we have someone farm the property, right, for a period of time. And then maybe a buyer comes along and it's too good a deal to pass up. There's no, I want my money back with that, right? Like your money's locked in. It is literally the ground.
Yep.
And so that's where I think the liquidity premium lets you experience the asset class and lets you be in the asset class, right? So to that extent, I think there's a huge argument to be made that illiquidity is relevant, because otherwise you couldn't improve that farm. Otherwise you would be moving too quickly between operators. Otherwise it would fail.
Yep.
No,
exactly. And you saw more institutional interest after 2008 in farmland in particular because of the Fed's quantitative easing strategy. And now, a lot of those funds, their sunset was the last couple of years. You saw institutional capital starting to gain interest in 2008, 2009. A lot of these funds kicked off in 2011, 2012 with a 10-year time horizon. And then 2022 hits and we are at the top of the land market, especially depending on where you were located at. And so there's this hesitancy of, okay, we were at the top of the land market in this period. Are we going to start to back off that? Is this really, because we want to buy low, sell high.
Right.
Is this truly the right time? And so the alts part of, with alts, there's the timing component as well of there's so many different factors you have to look at. We have to look at macroeconomic factors, microeconomic factors. If we're looking at agriculture, we need to look at commodities. We need to look at geopolitical risk.
Well, and you got to go global.
You got to look at global
the
trade.
hot second you throw commodities in, now you're looking at soybeans. You can't just look at the Midwest. You have to look at international.
Yeah, and you got to look at consumer trends around certain foods and diets. And if you're in California, we got to look at water. And so there's a lot of education that has to happen if somebody wants to be in the space, but it's out there. Like there are avenues for it. For sure.
There's the Kaya, there's the CFA, there's micro credentialing as well.
Yep.
And all those things go to this idea that we want to put alts on a platform.
There's a reality with alts that I see a trend time and time again, whether it's crypto with like NFTs, Legos, because that's an alt now, it looks like. Baseball cards, you have land.
Don't forget art.
There's
so much art.
There's a personal investment in a lot of these. And so it's making me think of people who want to go into Chick-fil-A, open up a franchise, and they're like, oh, this is just a side thing for you, you're out.
Yeah.
If you're looking into alts, it just looks to me like, it's going to take a certain level of ownership for it to be successful. Like you just said, like, oh, who's going to operate the land? You got to be in it. Illiquidity is kind of a good thing.
Yeah, and I would say that your point in hitting on this emotional aspect of it, that's both the beauty and the demise of alts in some strategies, especially when you look at art and other collectible items and even farmland. There is a lot of passion behind what those are, and there's a lot of fruits of labor, whether it is actual fruit, vegetables that are being produced, or it's art and it's something beautiful that somebody is looking at. And so there's that emotional aspect of it that can be, if you know that it is emotional for you, that can really be capitalized on. But at the same time, you sometimes see people holding on to things for too long in the space.
You have this idea of I think separating the romantic from the investment.
Yeah.
And specifically in things that have emotional value can get hard. One of the areas that I've studied on and off is home equity over the years. That's one of the things, and this conversation is dead on to that, right? There's these incredible biases we put in our houses. This house is sacred, home is sacred, home equity is sacred. When for an awful lot of retirees, home equity would unlock more substantial everything from food on the table to having a more enjoyous retirement. And in the end, with something like a house, sometimes at the end of the day, you have this romantic vision that your kids want it and your kids are going to come back. And when you're dead, your kids are going to live there. And the first thing your kids do is sell the thing, right? And you could have had a better retirement for it. To pivot to alts, though, right? We do struggle with the romantic versus the objective. And I think that's where money managers, investment advisors, and like folks like Ailie consultants can really help too, right? Because like getting this, like this piece of land makes a lot of sense as an investment. This piece of land is where your Meemaw had peaches. I think it's a different conversation. I think that's where you need your expertise to help with those.
Yeah, and even like not even that, the things that you physically see or touch, like there is emotional attachment to people that are in cryptocurrencies, and especially the people that were in it really early on.
Yeah.
We were just, we're live at the Land Investment Expo, and the speaker that was just speaking over lunch was talking about cryptos and talking about like the woo crypto people, because they're the people that no matter what's happening with cryptos, whether it's down or it's up, they are in it and they are supporting it.
I
And
love woo crypto. I love that.
the woo crypto. It was great. And so there is an emotional aspect to a lot of different alts, because it's not new from the standpoint of like these things cryptos are obviously new, but these other things like collectibles and land, those aren't new. They've been around for a long time.
Land is the original,
yeah.
right?
Yeah.
Like,
land is the OG.
That's the
It's like,
OG.
waving the OG flag.
Yeah, but it's really taken a new shape as an investable opportunity,
right,
especially over the last few decades. And so the people that started that early on are very emotionally attached to it.
Yeah,
and so it gets into that BFI conversation of why people buy the things that they do and why they hold on to the things that they do.
Heuristics and biases run in stocks, bonds, but they run in alts. I think they run deeper in alts too.
I would tend to agree with you too.
Yeah, I think so.
Well, the SEC is continuing to change their views on alternative investments, cryptocurrency, and yet last year there was a report that came out. I don't know how big or how many people were surveyed in this study, but of the top 5 investment mistakes that consumers reported, they said they either invested or pulled money as a response to emotion. And yet there's a gap here. Lots of advisors aren't talking about alts, period, or aren't helping be that advocate for their clients around alternative investments. So they're seeing things in the news, whether it's a Sig Bateman-Freud thing or whatever. People panic or people get excited. They invest out of emotion. It's common, especially if it's an alt. As we're seeing, people are more prone to do that. And I don't know, it seems to me like there is that gap. Where are they to go if their advisor isn't going to talk to them about it?
That's true. And it's funny because you've seen this gap for a long time, because people, when markets start to go down, especially equity markets, people run towards gold. And they're like, I got to go back towards gold. Like it's one of the original alts and the original alternative investments. So yeah, that rationalization, where do you go? Where do you seek education? As an advisor, it really is your job to be kind of a mini expert in everything. And advocating for your client in that way, and also understanding what you don't know and being able to find the resources. And luckily, we're going to subtly plug the U of I. University of Illinois has developed lots of online content where you can watch videos about alternative investments, and sending, these advisors can send their clients directly towards that, because clients shouldn't be investing in things that they don't understand either. And so it's not just that the advisor needs the education, it's the clients as well.
And I'll pitch on that and say that one of the things we've got down pretty good with insurance agents and registered reps and investment advisors, we're pretty good at punting when it comes to tax and law.
Sure.
Right? We're pretty good at that. We're saying like, okay, you need a will. And if you're, a wealthy, maybe a more complicated estate plan, I know what that is. And this is the person that can help you get that moving. And you meet with them, and they're going to be the attorney. Maybe I can help you get ready for the attorney. Maybe not, right? Depends on the relationship and context. But we'll punt that. We punt taxes, I would say 80% of the time, firms are punting taxes. 20% maybe they do it in-house. But most of the time, we're going to punt tax work. We're going to punt that. I'm not saying we punt alts, but I do think we need to develop what Ailie was suggesting is like, if I don't know about this asset class,
Right.
but my client has a lot of questions, then I need to find a reliable, trustworthy, good, source of information, content expert that person can go to and not get taken advantage of. Mm-hmm. So I think we need to get in a space where, are we going to learn it ourselves? One possible track, yes, we learn it ourselves.
Yeah.
If we're not going to learn it ourselves, let's adopt that accountant, attorney mentality and punt when it's appropriate.
The reality is, if we don't evolve, there's opportunity for someone else.
Oh, yeah.
I personally know of crypto coaches who said, well, I don't want to be held to any sort of standard, so I'm going to create these Dave Ramsey courses online that are broadly enough, one size fits all. Here's what explaining dollar cost averaging, all that, and helping people get into crypto that way. And I'm like, these aren't advisors. They've gone through no certifications, and yet they're making buku bucks.
Well, let's remember that an investment advisor is somebody that gives advice about a security. Okay. So crypto is not a security. Land is not a security. Right? Now, once you put land in a product, it becomes a security. And once you put crypto in a fund, it becomes a security.
Yeah.
But you have to remember that, I can give advice. And as long as it's not about securities, there is no licensure I need to give that advice. I can sit down and say, come talk to me about your retirement. As long as I'm not giving you advice on securities, I am scot-free. There's nothing regulating me. And that's the world we live and work in, right? Throw insurance products in, now you're regulated. Throw anything in, you're regulated. But that's where crypto got a weird start, because Bitcoin isn't a security and Ethereum's not a security. But the funds that sell them are, but the coin itself isn't. And so you can say whatever the heck you want. There's no repercussion.
Yeah.
So that's something to think about.
It is.
I remember the first time I got into crypto, I had a friend who created an NFT, and the whole thing was about, hey, everyone buys into this Ethereum product. We might all go into the moon together. We'll use these tickets to get you a ticket to the moon, and as it becomes commercialized. And
was it a monkey? Did a monkey hand you the ticket?
Yeah, and I looked at it, I was like, how is this the thing? He's like, oh, this is better. Then he showed me Bored Apes and all this other stuff that I'm like, wow, this is crazy. You're investing in you're investing in nothing, and it's its own space. But yeah, and that's where alts can get kind of a weird rap.
Yeah, you look at NFTs with athletes, things like that, and it's just very interesting to me. And it's something that I wouldn't feel comfortable in myself. Primarily, I like sports, but not enough to
do
make those kinds of bets. But that's just such an interesting thing. And you see these NFTs where people are just wrapping trips to the moon and a variety of different things, and it's just really interesting.
Oh yeah. But what's not as interesting, that's a lot more stable, is land. And people think, land's not going to change. But that's just not true. When I got here, I was talking to people about how soil is a depreciating asset. Hence, you should be able to receive tax benefits. All sorts of stuff. I never had conversations with people about this stuff. And I come here, and one person has a thought around that. Another person has an entirely different thought. And I'm like, okay, there is a lot of internal drama within this space.
Well, one thing I'll add on is we had a guest on the Land and Everything Else podcast, and we actually had back-to-back guests. I'm in Chicago, and we have two guests back-to-back, and one works for a very large investment company and managed, I would say, somewhere around 190,000 acres for them in row crop. The next guest was from Detroit, investment advisor, just wants to make the world a better place. All right. So you talk about land a little bit, and I'm about to kick this to Ailie. When we talked about land and innovations in land, opportunity zone investing came up. And I have rarely in my career seen two people on such opposite ends of the political and tax spectrum agree that this was a great idea. Mm-hmm. And so you had both of these guests talk about how opportunity zone investing, this has changed the landscape. It has reinvigorated Detroit to the other end. It has allowed development and, farmland and created better places for the world.
Yeah.
And that's where like the innovations and understanding it, and Ailie's an expert in this, so I'd love for you to pitch in. But you are.
Yeah.
But I think it's worth mentioning, like, this is why you gotta pay attention.
Yeah, no, it is. And it's so funny, especially in the opportunity zone space. So many people still haven't heard of it. And it's very interesting to me because, and just giving a little bit of background, under the 2017 Tax Cuts and Jobs Act, governors of every state got to designate a certain percentage of their land area based on census tracts as opportunity zones. And opportunity zones are economically distressed areas with high unemployment, very low income areas. And the governors of every state got to designate where they wanted, based on the census tract that met that criteria, which ones they wanted to designate as an opportunity zone. And so if there is investment in land in, let's say, a retirement community or something like that that is located in one of those areas, investors can get 3 main tax benefits. Well, they could. The program needs to be re-upped this, and I'm hopeful that maybe this year is the year. But they got a 10% step up in basis in their original capital gain. Let me back up. I didn't explain that. So how this works is an investor takes a capital gain that they have, and that capital gain can be in anything. It doesn't have to be
selling a business or something.
Yeah, selling a business or an investment portfolio or anything like that. They take the capital gain. They can invest it either in a qualified opportunity zone property or a qualified opportunity zone fund that then pools the investment. And so they can take their capital gain and invest it. As a result, if they hold their capital in the fund, there's a 10-year hold period, or a 10-year, they're directly managing the property, a 10-year hold period. They get a 10% step up in basis on their original capital gain. They get a deferral until 2026 on the tax, like the capital gains tax, until 2026, which is next year at this point. And then on the same token, any gain in the property value, so let's say I bought some farmland and the farmland appreciated by 20% from the first year, from 2020 to 2000, or let's say 2021 to 2031, all of that is tax-free. Any gain. Wow. The capital appreciation, all of that is tax-free. Now, the income still flows on your personal taxes and things like that. But the capital gain is tax-free, which is a very interesting component to this program. And there are opportunities to invest based on what your maybe emotions are.
Okay.
So if you are somebody in rural agriculture and you're very passionate about rural communities, there's tons of zones that are in rural areas, whether you want to invest in farmland directly or you want to invest maybe in a local community center.
Interesting.
In Detroit in particular, multifamily housing projects, retirement communities, any of these kind of that benefit the overall community, these can be investable asset classes. And the other part of the program is it's not just a buy and hold. You're buying and then you're improving the property. Mm-hmm. So if I buy farmland, let's say in the heart of Illinois, I can buy the land. I can invest in capital expenditures to improve the land, such as drainage tile, maybe irrigation system, depending on where it is, land leveling, other types of testing that needs to be done, grain bin structures that are going to help make the land more productive, the farmer more profitable.
Yeah.
You can do that. If you want to go into, like, let's say it's a multifamily housing unit or it's a retirement community, they have to make improvements up to a certain percentage of the property to be able to qualify for these benefits.
So who inspects that?
That's very interesting that you asked that. So I cannot speak towards the commercial side. I work for a fund that invests in farmland in that space. And it's very interesting. There's a couple certifications groups that we work with. We have a conservation easement on one of the properties, and we work with a group called Working Lands Trust that kind of works on the certification of all of that. It's kind of like anything. It's like an audit can happen at any time. I would assume the IRS is doing their digging and fact checking here and there. But yeah, I can't speak towards the maybe commercial real estate side of things.
Sure.
But farmland, that's kind of how it's worked so far.
Do you think those audits dissuade people from investing in opportunity zones?
I think the tax benefits and community benefits way outweigh. I mean, the thing is that, like, you're investing, you're making the property better, right? It's not like you're making something up. I mean, there's a legitimate improvement. So, I mean, I think that is just an example when we talk about alts and land, right? Now, the opportunity zone is a tax structure. So then you have to figure out within that tax structure, what asset class am I buying? Yeah. So within the tax structure of opportunity zones, am I going to do rural farmland? Am I going to do multifamily housing? Am I going to do corporate improvement? Am I going to do downtown? But all those areas, it makes the asset classes more attractive because you're going to pay less tax across the board on those things.
Yeah. Well, and it makes it more attractive when you leave it. Like you're
you left it better than you found it.
Exactly.
And I think there's a value to that across the board.
And that's why it's got such bipartisan support. It really does. And I think it was so cool when Craig got to interview the person from the Detroit area that has gotten to see this happen and in Detroit and in particular. And these areas that, frankly, the U.S. government is not investing in. And nor do they have the capital capacity to be able to invest in every single these areas that need investment. So why not drive outside capital that are looking for a premium to these areas that's going to make it better for everyone?
Yeah.
And so, I don't know. It's kind of like that beautiful rainbow structure, in my opinion.
And we talk about infrastructure and alternatives, right?
Yes.
Like investing. How do I invest in infrastructure?
Yeah.
Well, the city owns the bridge. The city updates the bridge. There may not be any revenue associated with the bridge. It might be all municipal bond funded. Yeah. But when it comes to the buildings around the bridge and suddenly downtown gets revitalized and now there's a building, there can be a little coffee shop, new apartments, and you get more money moving in, higher tax base. It's one of those things where understanding alts, the asset classes, and the tax structures to do well by your clients, that's the kind of thinking you need to start doing.
So pulling the crystal ball from under the table here, we mentioned at the beginning of the podcast, Donald Trump's in office. Things are going to change, for better or for worse. That's just change is coming. What's the one thing we should be paying attention to with farmland investments over the next 4 years? Just one.
I'll give it a shot.
Just one.
I've got.
You go ahead.
I'll
give my 2 cents.
I have seen, and we continue to see, a trickle down of non-stock and bond investments from big money players to people rolling IRAs over from their qualified plans. We see more demand in that space. We see an interest in saying, okay, should I have 10, 20, 30, 40% of this asset allocation in something that's not a stock or not a bond? And now we have the tech platforms to do it where we didn't 20 years ago. There really was no democratization. Today there is. So to me, the biggest innovation is going to say, how can we fractionalize in a cost-effective and meaningful way some of these investment opportunities that trickle down into consumer portfolios? Land is certainly one of those areas that we'll see. So to me, that's what we look out for this year. We look for more platforms, more custodial programs, more ways of doing it. And I think we'll see that happen in 2025 to 2030. You'll start seeing that become more mainstream, but you're going to see that for legitimate asset classes, and then you're going to see that for digital monkeys. And I think we need to some extent be able to advise on that. But now I'll kick it to Ailie on land.
So we look at any type of land, we think of like the 3 I's. You think income, interest rates, inflation, and those obviously all interconnect with one another. And in agriculture, that is no different. So we look at the economics of, let's start with inflation. Agriculture and farmland is known to have a positive correlation with inflation. And so during periods of high inflation, like we saw for the last 5 years, you've seen boost in land values. And so when it comes to inflation, that is something I am really looking at as a potential driver for land values in the next maybe administration. The jury is still out on what inflation is going to look like and what the Fed, how the Fed might respond. But when we look at the tariffs that are being proposed, we look at the immigration policies and things like that, those all have potential to be inflation driving.
They do.
Scenarios.
Sure. Yeah.
And you can't just forget about that aspect of it. And so that kind of brings me to my next point about income. We've seen really depressed commodity prices for your traditional row crop in this last year. And when it comes to, the future president's status on trade and tariffs, that could have a pretty big impact on farmers and on farmland subsequently. And so you've got inflation, which I'm a little bit bullish on inflation, I'm not going to lie. And then I'm also, on the flip side, bearish on farm incomes. And so I think we're in for some years of not high growth. I think it's just going to be kind of steady. I don't think we're in for a overcorrection and backtracking by any means. It's regionally as well, depending on where we're looking at. If you look at California, it's a whole other game because we've got 50% roughly of all work that is done in agriculture, like actual labor, is done by migrant workers in California because it's very, very demanding. Avocados, pistachios, berries, all of that is very, very labor intensive. And so if there were to be some kind of immigration policy that prevented migrant workers from coming in to do that kind of work, you're going to see some pressure on supply chains and pressure on these farms, which could raise food prices, you know. And so it's an offset. And so I would say over the next 4 years, I'm not bullish, but I'm not bearish either, I guess, in agriculture. Traditionally, agriculture doesn't do well under conservative presidents, which is kind of interesting because that's their voting base. And so I think it'll be interesting. It's a learning experience for me.
Yep. No one knows what tomorrow is going to bring. I spent all of last week in Los Angeles, so hopefully there will be avocados 4 years from now for people to actually take care of. But beside the point, we're about at time here, and I want to end on something fun before we let you go. I'm curious as to what alt you get the most joy out of yourself. Whether it's a toy, whether it's jewelry, whatever it is. While you're both thinking, I'll go ahead and start.
Okay.
I love Legos. During the pandemic, I got a set. I didn't think, for Christmas, and I was like, okay, I'll put it together. Loved it. Now it became this family thing. We over the summer find a big Lego, put it together, and I looked up the value online. Even if it's all done and put together, as long as you own the box, you can still sell, if it's been discontinued, most Legos at minimum 25% more of its original retail value.
That's crazy.
And so I've got this really nice Lord of the Rings set sitting at home unboxed. I got 2 of them just in case. My wife's like, you're never selling this. I'm like, I know, but just look at it. In the box, out of the box, just joy. So anyways, Lego is mine.
Yeah.
Probably won't make any money out of this, but I know people who have huge spreadsheets and do. That's their thing. What about y'all?
I mean, obviously, I'm a farmer. My family farms. And so the default answer for me would be farmland, but I'm not going to go there because that's the default, and I've been talking a lot about farmland. I'll talk about my other love, which is horses. And it seems very fitting since this is produced by Pod Pony to talk about ponies.
We paid her to talk about this, actually.
I grew up with horses and have always had them. I have made absolutely no money on them. My return is probably a negative 2,000% at this point. I consult to pay for that part of my life, which is really funny. But anyway, when I bought my last horse, she's amazing. The woman I bought her for is incredible. And she was like, you're really making an investment in your future. And I'm like, I don't see this as an investment in my future. I mean, I see it as an investment in me and my joy and my happiness, but not from a money aspect.
Yeah.
But it's crazy because there is a market for horses in the alternative space, whether you're talking about horse racing in Kentucky and other parts of the country, or you're talking about, this is going to sound maybe a little bit too graphic, but even the semen for horses sells for millions of dollars if it's a winner. And so it's wild to me that there is that much money in that space, which is really interesting. There's some documentaries about like fraud in the horse industry.
Oh my gosh,
and
it's a whole thing.
It's a whole thing. And
We got to do a podcast on horses.
You got to do a podcast on it. I think it would be great. But for me, my personal, I make no money on my horse. It is just all love and joy. So.
Yeah.
So I'm going up against Legos and horse husbandry. Okay. So I think here's the thing. Like, I have never been a collector of anything in particular. Probably a little minimalist in the back of my head, at least who I want to be. You go in my house and it's a mess, but that's here nor there. So I think to me, there's something about art that I find really interesting, right? And I think art from the standpoint that often it's bought at auction, covered up in a box, put in a warehouse for dozens of years at a time.
Yeah.
And they're like, oh, yeah, no, we got this Van Gogh, and it's in the warehouse.
Yeah.
And then sometimes you do weird stuff with it. Like, you actually put it at a port of entry warehouse that's not really in the United States yet. And it just sits. It sits, and everyone dies, and it sits, right? But I find that the whole market around it fascinating.
Yeah.
Is like the way that we buy it and sell it and enjoy it and yet put it away. It's weird. Yeah. And so I think art is one of those things where I just enjoy learning more about it. I find recreational hobby-wise, I like to paint. But those are things where it puzzles me to no end, the high-end art market and alts. And then you see people fractionalizing it too. And like, you want to own a little piece of that warehouse where we have the Van Gogh locked away forever?
Yeah.
And like,
Goes back to
I'll own a piece of it.
NFTs and digital assets.
And now I own a little piece of this warehouse where there is actually master art in it. And you're like, but now I can trade it? You want this? And so I find that just fascinating right now. I'm really into it. And I think that's like my current passion of really understanding that world a little better.
Yeah.
Well, and sometimes you can go to a fruit stand, buy a piece of fruit, and then tape it to a wall, and it sells for $6 million.
But then I'm going to take that. I'm going to take the wall. I'm going to chip it away. I'm going to put it in the warehouse. I'm going to box it up.
Yeah.
And then 2 generations from now, my grandkids will be like, oh, there's a raisin on a wall. But I love that. I think that art's my answer.
Yeah,
awesome.
That's a good one.
Well, thank you for creating this masterpiece of an episode. This is the first impressionistic podcast I've ever done, the blend of two. This is the Land and Everything Else / FinTape. The Land and Everything tape?
We'll take
the land tape?
Land tape.
The land tape episode.
Enjoy the land tape.
It's been a ton of fun. Hey, listener, thanks so much for pulling up a chair and checking this out with us. You know what to do. Whatever show you're listening on, go check out the links in the description. We're going to have another episode out in a couple weeks. I don't know what it's going to be, but I know it's going to be good. So hit subscribe so you don't miss it. We'll see you then.